The screen glows. Your finger hovers over the mouse a hair's breadth from the buy button. A flicker of green on the screen and your heart quickens. You're in. A few moments later, a flicker of red. You're out. You made a few dollars, or perhaps you lost a few. It doesn't matter. The important thing is the action, the feeling of being in the game. You do this 10, 20, 50 times a day. You feel busy, you feel like a trader. But when you look at your account statement at the end of the week, you see the truth. You have been bled dry by 1,000 tiny cuts. Each commission, each small loss, each sliver of slippage has acted as a leech on your capital. You have been active, but you have not been profitable. You have been overtrading, a disease of the soul that masquerades as diligence. This compulsion to act, to constantly be doing something, is one of the most insidious traps in the market. It stems from a fundamental misunderstanding of our role as speculators. The market is not a casino that rewards you for placing more bets. It is a vast, deep ocean, and we are fishermen. A fisherman does not cast his line into empty water 1,000 times, hoping a fish will magically appear. He studies the currents, the tides, the weather. He waits for the precise moment when the fish are running, and only then does he cast his net. The rest of the time, he is mending his nets, studying his charts, or simply sitting in his boat, patiently watching the water. Most of your time as a speculator should be spent in this state of patient observation. The impulse to trade constantly comes from the ego. It is the ego that cannot stand to be idle, for it equates stillness with failure. It is the ego that fears missing a small move, and in its panic it causes you to miss the only move that matters. The large, decisive swing that brings true wealth. This is not a new affliction. It is a flaw in human nature as old as the markets themselves. I learned this lesson not from a book, but from the brutal tuition of the tape. I remember a time early in my career after I had made a significant sum from a move in a major railroad stock. I was young, flush with cash, and I believed I had deciphered the market's secret language. I thought I could hear it whisper its intentions to me with every tick. With this arrogance, I turned my attention to the cotton market. Cotton was a different beast entirely. It was not in a clear trend. Instead, it was trapped in a dull, grinding range, moving a few points up, a few points down, day after day. It was a market for specialists and locals in the pit, not for a speculator looking for a substantial move. But my ego would not let me sit still. I had capital, and I felt it must be working. So I waded in. I would buy on a small sign of strength only to see it evaporate and get stopped out for a small loss. Annoyed, I would then go short on a sign of weakness, and the market would immediately reverse, handing me another small loss. For weeks, this was my routine. I was glued to the quote board, my mind racing, trying to outwit a market that had no intention of going anywhere. I was trading on hope, on nervousness, on boredom. I was taking every signal, real or imagined. I was a gambler pulling the arm of a slot machine, not a speculator executing a well-defined campaign. Each loss was small enough to be dismissed. 1/4 of a point here, 1/2 a point there. But they accumulated. The constant stream of small losses was more demoralizing than a single large blow. A large loss is a clean wound. It can be stitched up and learned from. Overtrading is a systemic poison. It drains not only your capital, but your confidence, your clarity, and your mental energy. It turns the art of speculation into a frantic, meaningless job. I was exhausted. One day I tallied the commissions I had paid and the small losses I had sustained. The sum was staggering. I had given away a small fortune for absolutely no reason other than my inability to sit still. That was the day I learned that my time and my capital were my most precious assets. Time to wait for the perfect setup. and the capital to act decisively when it finally arrived. Wasting either on insignificant noise is the cardinal sin of a speculator. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. I teach you the discipline and the mindset, the psychology of why prices move as they do. But for the precise mechanics, exactly where, how, and when to execute the trade, you need a more granular structure. You need a method for reading the tape's intentions bar by bar. For this, there is no one better than my contemporary Richard Wyckoff. He was a master at dissecting the maneuvers of the large operators, at identifying the phases of accumulation and distribution that precede all major moves. I give you the philosophy, he gives you the blueprint. Use them together. I have left the link to the Richard Wyckoff Trading Methods channel in the description below. Use it to complete your arsenal. Today, the temptation to overtrade is 1,000 times what it was in my day. You have the market in your pocket. A constant stream of news, opinions, and alerts floods your mind. The blinking lights of your terminal are designed to provoke a response, to keep you engaged, to make you feel that if you are not clicking, you are losing. This is a grand illusion. Consider a volatile sector like energy exploration. A small company, let's call it Western Basin Oil, puts out a press release about a promising test well in a new field. The news hits your screen and the stock immediately gaps up 15% on your chart. The crowd piles in. FOMO, the fear of missing out, grips you. You buy, chasing the price higher. The initial burst of buying exhausts itself and the price pulls back. Panic sets in. You sell for a small loss, convinced you bought the top. A few minutes later, institutional orders begin to absorb the selling and the price stabilizes, then begins to climb again. Now you feel foolish. You buy back in, at a higher price than your first entry, determined not to miss the real move this time. The stock chops around, moving up and down in a violent range as short-term traders are shaken out. You are whipsawed, your emotions are frayed, and by the end of the day, whether you have a small profit or a small loss is almost irrelevant. The real cost has been to your mental capital. You have been reacting, not thinking. The antidote to this poison is not a more complex indicator or a faster news feed. It is a set of rigid, unbreakable rules that you impose upon yourself. This is how you transform from a gambler into a speculator. First, you must define precisely what constitutes a high probability setup for you. Write it down. Does it require a general market uptrend? Does it require the stock to be emerging from a multi-week consolidation? Does it require a specific volume signature? Be ruthlessly specific. This written plan becomes your gatekeeper. When you feel the urge to trade, you must consult this document. If the current market action does not tick every single box on your list, you are forbidden from touching the mouse. This single act of discipline will eliminate 90% of your impulsive trades. Second, impose a hard limit on your activity. A professional card player does not play every hand. He folds again and again, waiting for a statistical advantage. You must do the same. Limit yourself to a maximum of, say, 2 or 3 trades per week. This forces you to be selective. It elevates the act of trading from a nervous tick to a deliberate, calculated action. If you use up your quota on mediocre setups, you will have no ammunition left when the perfect opportunity finally presents itself. When your limit is reached, your work is done. You close the platform and walk away. Third, learn to distinguish between boredom and opportunity. The market is often boring. A stock can do nothing for days or weeks on end. This is not a problem to be solved. It is a condition to be embraced. The urge to trade often comes from a simple need for stimulation. When you feel that itch, that restlessness in front of the screen, it is a signal not to trade, but to step away. Get up from your chair, walk outside, read a book. Do anything that breaks the hypnotic spell of the flickering screen. When you return, the emotional urge will have likely passed, and you will see the market with clear, objective eyes. And finally, your most important work is done when the market is closed. Your evening ritual should not be searching for tomorrow's hot tip. It should be a quiet, methodical review of your trading journal. Look at the trades you took. Did they conform to your plan? Was your entry logical? Was your exit disciplined? Or were they driven by greed, fear, or impatience? This self-examination is where true growth occurs. You're not trying to predict the market. You are trying to master yourself. What if you recognize this pattern in your own behavior? What if you look at your account and see the evidence of overtrading staring back at you? The first step is to stop the bleeding. If you have had a day or a week of frantic, unprofitable activity, the worst thing you can do is try to make it back the next day. This is the gambler's fallacy. You are emotionally compromised. Your judgment is clouded. The single most powerful action you can take is to declare a moratorium on your trading. Take the next 2 or even 3 days completely off. Do not look at a chart. Do not read financial news. Unplug yourself from the stream of information. You must break the psychological feedback loop that drives your compulsion. Your goal is not to win back the money. Your goal is to win back your discipline. When you return to the terminal, you do so with a renewed commitment to your rules, not with a desperate need to repair your equity curve. There is another, more subtle form of this disease. It can strike even when you are in a correct and profitable trade. You have done the work. You waited patiently, you identified a stock beginning a major move, and you established your position. The stock is moving in your favor. But the itch returns. The stock pulls back for a day or two, which is a perfectly normal and healthy consolidation. Your impatience tells you to sell and lock in the small profit. Or the stock has a strong day and your greed tells you to add to your position impulsively, without a proper technical reason, deviating from your pyramiding plan. This is overmanaging. This is a lack of faith in your own initial judgment. You are snatching at dimes when you should be waiting for dollars. The cure is the same. Trust your plan. Your initial analysis, conducted when you were calm and objective, is almost always superior to the emotional decisions you make in the heat of the moment. You placed your protective stop for a reason. Let it do its job. You identified a price objective for a reason. Have the patience to let the trade unfold. The great moves, the ones that build fortunes, do not happen overnight. They take time to develop. The money you see is not made in the buying or the selling. It is made in the sitting. It is made in the quiet, disciplined patience of holding a position that is acting correctly, along the line of least resistance. The novice believes a speculator is a man of constant, frenetic action. The master knows a speculator is a man of profound, almost inhuman patience. He acts only when all the probabilities are stacked in his favor, and then he acts with conviction. The rest of the time he waits. He watches. He thinks. Your goal is not to trade the market every day. Your goal is to extract large profits from the market a few times a year. This requires a fundamental shift in your perception of time and of your own role. You are not a worker paid by the hour. You are a hunter waiting for the perfect shot. Stop wasting your ammunition on shadows. Conserve your mental and financial capital for the moments that truly matter. Rid yourself of the need for constant action and embrace the power of strategic inaction. Stay disciplined.